Welcome, everyone. Today, we have a very special guest. Myself and Michael Zuber are going to be interviewing someone that is very well known. He was the chief economist at Morgan Stanley. He was the chairman of their Asia investment division. He is a Yale University professor, and without a doubt, he is one of the leading experts when it comes to the U.S. and China economic policy. His name is Stephen Roach, and today we're going to spend about 30 to 40 minutes with him talking about all sorts of things related to the economy, and picking his brain for ideas and just concepts. So join us, and before we get started, make sure to subscribe, and you'll get all the off-market deals and reports that I give to all my members. So let's get started. All right, everyone, welcome. Today we have a special guest, and by special, that's an understatement. Mr. Stephen Roach from Yale University, in his past chief economist for Morgan Stanley. He's written a book called Unbalanced, which I'm about halfway through, and it's just a fantastic read. So today we'll be talking about two main things, the China and U.S. relationship, and then inflation or the risk to the U.S. dollar. So with that said, hats off to you, Mr. Roach, and would you mind giving us maybe a quick 1-2 minute spiel of your background and journey?
Well, for the bulk of my career, I was the chief economist at Morgan Stanley, and where I worked for 30 years. Toward the end of my Wall Street career, after having developed a real interest in Asia in general and China in particular, the firm shipped me out to Hong Kong, where I headed up their Asia business as the chairman of Morgan Stanley Asia. During that 5-year period, roughly from 2007 to 2012, I spent the bulk of my time in China, even though I lived in Hong Kong, and finally decided to move back into academia, where I started out decades ago, and have been teaching at Yale ever since, teaching very popular course called The Next China, which draws heavily on my book, Unbalanced, the Codependency of American China. Also teach seminar on the lessons of Japan, and I'm eagerly looking forward to the start of school remotely in a few days at Yale again.
Awesome. Yeah, in your book, one of the key, concepts that you talk about in detail is called this false prosperity. And I think, when it relates to how the U.S. economy is built in terms of a consumption economy, it's really pertinent to a lot of investors that we talk to think about how that may play out in their strategies and overall, ways of buying assets and just how they go about their own spending and consumption. So would you mind kind of explaining what false prosperity means to you, and I guess maybe the pros and cons at a high level to the U.S. economy?
Well, yeah, that's an important point, at least in my point of view. Everybody wants growth, and developing economies, of course, want it more than others because they want to develop and become rich. And the notion of false prosperity is that a lot of politicians, sometimes politicians who co-opt policymakers, will try to squeeze too much juice out of the lemon. They'll push economies too far, well beyond what is sustainable based on the fundamentals of job growth and income generation, and they'll take risk. And sometimes that risk works out, and sometimes it doesn't. In the case of the U.S., we pushed much too hard, beginning in the late 1990s, to squeeze economic growth out of asset bubbles. First, equities, you remember .com, then property, and then credit bubbles. And that works until it doesn't. And what we know about financial bubbles is, eventually they burst, and those who ended up borrowing too much on the basis of collateral that had formed a bubble get sort of left holding the bag, and they have to pull back very sharply. We've seen that repeatedly in our bubble-induced recessions, again, of the early 2000s, 2007, 2008, during the global financial crisis. And who knows, possibly again right now as equity markets soar in a very weak U.S. and global environment. So false prosperity just means going too far. And, the U.S. is not alone. I mean, we had bubbles around the developed world. Japan was, of course, first with its bubbles in the late 1980s. China's had periodic property and equity bubbles. And so, these are calculated risks, sometimes not calculated, that policymakers, politicians take, and that sort of drags, the investors in the private economy down that same, sometimes precarious and dangerous road.
Yep, and that it sounds like as if the politicians and the Fed, to some extent, push the incentives to spend, the incentives based around this false prosperity, which relate to more consumption as a percentage of GDP. And I think from what I've seen, and as you detail in your book, the percentage of consumption-based GDP relative to overall GDP has increased over time. And I guess I want to know, I mean, at some point that's not sustainable, and we may already be past that point. So obviously we have to start thinking about how we can get people to invest more, save more, produce in different ways. I mean, just generally speaking, from a risk standpoint, where do you think we are when it comes to the consumption-based economy versus everything else?
Well, the U.S., I write about the U.S. In my book. I call the American style of economic growth as following the model of the ultimate consumer. We've pushed the envelope in terms of the consumption share of GDP, as you indicated, much further than anyone else. And the asset bubbles that have formed repeatedly in the U.S. since the late 1990s has been an important part of that culture of excess consumption. We have come to believe, and this has been aided and abetted by the deliberate strategies of the Federal Reserve, starting with the maestro himself, Alan Greenspan, that asset appreciation and the bubbles they form is the functional equivalent of a permanent increase in saving. And yet time and again, those asset bubbles burst, and the saving that we thought was going to be enduring evaporates before our eyes. And so consumers get into these periodic balance sheet recessions. They have to restore their income-based saving to make them whole. And that leads to very sharp adjustments in saving behavior, consumption behavior, and ultimately recessions. How far are we away from
calamity?
Changing the model? Not too far at all. I mean, we think this is the way to go, and we do so with great peril, in my opinion.
Yep. Yes. Let me ask one question, and then Zuber, I'll let you take it away. So again, in your book, this is all really possible because China is dependent upon our, consumption demand, right? They have cheap ways to produce right now. But as you mentioned in your book, at some point, estimated around 2040, 2050, their per capita income will be near what the U.S. is, right? And so at some point, they're not going to be the main producers of goods at a cheap manner. Now, that might go to Vietnam, might go to Philippines, who knows? But the U.S. consumption model is only sustainable so long as we can acquire cheap goods. So that's a big risk as China develops in their economy and the middle class becomes upper class and so forth. We are going to have to figure out a way to change the model or adapt to other avenues. So I guess, just a few, what are some comments on that in terms of, how sustainable is it really? I mean, it's as it relates to China.
Well, the U.S., as I call the ultimate consumer, I call China the ultimate producer. But you're right. I mean, China for the last 10 or 12 years has been focused on changing its model, rebalancing its economic structure, moving away from exports and investment toward a model that is driven increasingly by internal private consumption to promote the emergence of, what is clearly going to be the largest middle class the world has ever seen, and the most important source of aggregate consumer demand in the world in the 21st century. And so this dynamic between America as the consumer and China as the producer, it worked really well for a long time, but it's changing. And this is the principal theme of my book, Unbalanced, because the codependency between our two countries was never sustainable. It was just a temporary state of affairs. And in a codependent human relationship, which is where I took the broad structure of the book from, when one partner changes the rules of engagement, the other one gets ticked off, feels left behind and scorned, and gets into a sort of a blame game that's been manifested in the form of a trade war that we're living through right now. So it may seem like a stretch, and I was really criticized for my psychoanalysis of two economies when I wrote the book. Well, guess what? It's playing out in spades right now as the psychodrama becomes an economic drama, courtesy of our psychologically impaired president, Donald Trump.
Yeah. One of the things I'd love to ask you about, I think it was in the middle of July, I saw you on CNBC talking about the risk of a double dip recession. And one of the things that I follow is the consumer. And we clearly have a disconnect between Wall Street and Main Street. I don't think that's talking out of school. But the question I had for you is, when you start looking at this double dip recession, do you have some early indicators that you think we should be watching? Is it, flash data from companies like Walmart, or where do you think it starts? Because it's probably already happening, but where do we kind of get validation that this double dip recession is a true risk? And where do we see that crumbling first, do you think?
Well, a few things. It's a great topic, and I actually have an article coming out about that in the next few days. And I don't know when your podcast comes out, but you can link to this article that will be out on Project Syndicate in the next few days.
Okay.
The double dip is it happens more often than not. What's a double dip? I use the GDP, quarterly GDP to measure it. It's an economy that has entered a recession, appears to come out with positive growth as we're going to have, in the third quarter of this year. It's an arithmetic certainty.
Yeah,
but then it goes back into negative territory.
Yeah.
By the way, it's happened. If you look at the history of post-World War II recessions, it's happened in 8 of the 11 recessions. They've been double dips, and 2 of those 8 have been triple dips, where the economy comes up, goes down again, comes up, and goes down again. Why does it happen? It happens for 2 reasons. The economy remains vulnerable because it's been hit hard by the initial shock. And secondly, the aftershocks just continue to play out. So this combination of vulnerability and the likelihood of aftershocks is the place to look. And so look at that framework vis-a-vis where we are today. We've just been hit by the worst shock in our history. A 33% annualized drop in real GDP in the second quarter of this year breaks anything close to prior records. The previous worst case quarter was minus 10 in the late 1950s. So we have been clobbered, and then the aftershocks I think are a distinct possibility. Our COVID infection rate is running about 45,000 new cases a day. That's double what it was a few months ago. The University of Washington says, we're going to have 1,000 deaths a day between now and the end of the year.
Wow.
This is a very real ongoing risk to Americans who are fearful of engaging in face-to-face services activity like eating in restaurants, shopping in stores, travel, and leisure. So I think there's a compelling case. Watch the quarterly GDP. The third quarter is going to be a strong rebound, but I'm worried about the fourth quarter of this year, the first quarter of next year. I think the odds of a double dip based on history are very, very high, and I think this time is not going to be any different.
Yeah. And then the other question I wanted to make sure I got your purview on is, again, as a real estate guy, one of the things that is at least single family homes. The vast market of the U.S. is having a good time, right? Big cities, New York, San Francisco, arguably struggling both with rent and value. But when you look at the urban flight, the rush to the suburbs, and the fact that real estate generally is 10% of GDP, can it punch above its weight class? Or do you think this is just a caffeine or a sugar high because of low rates and some pent up millennials who've been living in apartments too long that are now owning, and this too will pass in the double dip recession? Or you have any thoughts about the general single
Look, you
family
guys are
market?
the experts. I'm just, somebody who's, bought and sold homes for a long period. I do see what's going on is that, there's flight from urban centers. I love cities. My favorite city in the world is New York, and it looks cataclysmic there right now. Rental vacancy rates are double their pre-COVID norms, and my friends are fleeing the city and going to their second homes, and I don't know if they'll ever go back. And I worry about the future of cities. I think ultimately, though, real estate, has been a great investment for a long, long period of time. But the way the markets are being disrupted right now, and the persistence of unusually high unemployment and incomes remaining under pressure, those are powerful headwinds, even in an era of low interest rates and the demand for shelter. So I think it's going to be a long time before the real estate business truly establishes a new equilibrium, settles out. I see what's going on to suburban values right now, but is that sustainable? Those are open questions.
Yeah, I think, I think Zuber, as you know, a big component of this is really just supply and demand, right? We have a massive, well, I guess pre-COVID, we had a 2.5 million unit shortage, and builders pulled back like 40% on their building. So, and they were already building at a level that was below what they needed, right? So, until that somehow figures itself out, I don't really know. But that's a good point that you bring up, Stephen, about the sort of the income, if you will. And when you think about the income, wage growth hasn't been a rocket ship, but the risk to wages could be inflation or the risk in the devaluing of the dollar, right? So I'd be curious to get your thoughts. What are some preliminary signs that the dollar has some risk right now? I just saw Ray Dalio pick up a big gold position. Buffett just had a $560 million position in Barrick Gold. Gold's at an all-time high. Silver's climbing. I mean, what are you seeing as some risk to the dollar?
Well, I just go back to my humble task as an economist. I'm not, Warren Buffett or Ray Dalio, and I'll let them speak for themselves in terms of the positions that they take in markets. But, vis-a-vis the earlier point we discussed, saving, I'm a big believer that no economy can prosper over the long haul without saving. And as I look at the U.S., we've tried to do it. We've tried to substitute asset-based savings for income-based savings. But ultimately, I worry about that as a sustainable trajectory for the United States or for any economy. Pre-COVID, our domestic savings rate, which is the sum total of the saving by businesses, households, and the government sector. And then I had take out the portion of that goes to the depreciation of the sort of obsolete or worn out capital. So I look at what I call the net national savings rate. The government publishes this number every quarter. In the first quarter of 2020, pre-COVID, it was 2.9% of national income, which is amazingly low. Our historical net national or net domestic savings rate was 7% in the 45 years from 1960 to 2005. The net savings rate today is going sharply into negative territory as massive government budget deficits far offset the temporary surge of household saving that was brought about, by these $1,200 checks and the extended unemployment benefits, which have now, of course, expired due to the irresponsible lack of negotiations on, another deal by the U.S. Congress. As the net domestic savings rate goes sharply into negative territory, our balance of payments deficit is going to blow up. Countries that don't save and want to grow import surplus capital from abroad, and they run massive balance of payments deficits to attract the capital. When countries have, even the United States, have big balance of payments deficits, there's two powerful adjustment mechanisms that take place to attract the foreign capital, either a cheaper dollar or higher interest rates. The Fed has made a conscious decision to keep interest rates low, so the adjustment mechanism will show up through the currency. And that's why I've got this view that the dollar is in the early stages of a sharp decline. I see the dollar index dropping 35% in real terms over the next couple of years. And we've seen about 10 points of that, but we have a lot more to go. So I'm very focused on the dollar as the adjustment mechanism in this period of sharp reductions in net domestic savings.
Stephen, that was the one question I wanted to follow up on the dollar. I saw your call for 35% here recently. Let's try to simplify this for the average American, right? Who A, is not an economist, B, doesn't have an advanced degree, doesn't have the worlds of experience that you have. Where are they going to see it? Where does a 35% drop in the purchasing power of the dollar affect the average American?
Well, that's a fair question. Currency relations are, if you don't travel and if you don't have a real desire to look at buying foreign goods or domestic goods, why worry about it? You worry about it for a couple of reasons. One, currencies are relative prices. They compare our country vis-a-vis other countries. The dollar's been strong since 2011, as the world has really given us a vote of confidence vis-a-vis other nations. But in the same sense they've given us that vote of confidence, we have now led the world on the debate towards deglobalization, decoupling, trade protectionism. We've attacked, or at least our administration has attacked the world's leading institutions, like global institutions like the IMF, the World Bank, the World Trade Organization, the World Health Organization. We've pulled out of the Paris Agreement on climate change, the Trans-Pacific Partnership. We have failed miserably in dealing with the coronavirus vis-a-vis other countries. Our infection rate, it's improved a little bit in the last few weeks, but it's still triple that of the European Union, whose population is 35% larger than ours. And of course, we have a systemic problem with racism that has been glaringly apparent in the aftermath of the appalling public murder of George Floyd. So the world is looking at us, once the unquestioned leader of the free world, I think, with a much more jaundiced eye. And I think the average American is deeply concerned about that and will likely get more concerned going forward. And as the dollar comes under pressure, I think the average American citizen will feel those concerns very deeply and will look to other segments of the world economy and foreign exchange markets for more stable and possibly a more greater value in their currencies.
Yeah, I think most closely to home, right? Again, a lot of those goods come from China, which are bought by US dollars, right? So those prices should go up across the Walmarts, Targets of the world, Amazon. I mean, I don't know what portion of it is, but I believe a lot of people on Amazon who sell goods are buying them from Chinese manufacturers.
Well,
And the
they've been
drop
doing that for a long time.
right.
And, of course, the Trump administration has launched a full-blown trade war against anything that comes from China or reflects components from China, or that even is available on these Chinese apps like the teenage app TikTok or social media WeChat. There's no logic to that. It just reflects the fact that the president is in very bad shape politically. And in large part, that is an outgrowth of his malfeasance in dealing with the coronavirus. And the Republican strategists have advised him, and he's taken the bait completely, to attack China to deflect attention away from his malfeasance in addressing COVID-19. This has been leaked out in strategy documents that the Republican advisors have been very transparent in putting out in the last few months. And the president and his minions, I called them in a piece I wrote a few weeks ago, America's Gang of Four.
Yeah.
National Security Director O'Brien, FBI Director Chris Wray, the Secretary of State Mike Pompeo, and there's one more whose name I can't remember, that rounds out the Gang of Four. They have led the charge in the most vitriolic assault on a nation like China that we haven't seen really since the McCarthyism of the early 1950s. It's pretty appalling, in my opinion.
Yeah, and it seems, at least on the surface, that there's a retaliation measure going on in China to almost compete with this combative nature that we're seeing in the U.S.
Well, that's what happens when codependency becomes unhinged in humans. The two partners that have sort of coexisted in this sort of marriage of convenience start to attack each other, and that becomes a serious problem.
Yep. Awesome. Well, hey, I appreciate your time. I think we know where you stand on your political divide.
Well, I try to be apolitical in doing my work, because I think that injects, sometimes a contentious note of bias, and people start to question your objectivity as an economic analyst. But there are times where I make exceptions because the politics really do have an important impact on the economic framework, and this is one of those times.
Yeah, the one question I wanted to ask if we had time, Stephen, is actually I'm an econ grad from Santa Clara University way back in 1995, and you're about to go back and train some students at Yale here in a few days. Has anything changed in 25 years? Are you teaching anything new to the undergrads in economics?
Yeah, lots changed. I mean, we're in the midst of a trade war. Where does a trade war come from? What's it mean? How do we resolve it? I think we've really had to sort of bring this dynamic into the macroeconomic framework in ways that none of us ever envisioned. When I studied economics as a grad student, believe it or not, it tells you how old I am, in the late 60s and early 70s, I mean, we didn't spend a lot of time focusing on the likelihood of a full-blown trade war. We harbored the false presumption that, we learned the lessons of history, that, we did this once in the 1930s. Right. That was before my time. And it ended very, very poorly. The whole world was dragged into a trade war. But this is a political environment that really has no clear appreciation of these painful lessons of history. This notion that we have a political dynamic that has mastered the art of the deal, that can throw around tariffs and other forms of trade protectionism with impunity, is really
Reckless.
pretty appalling and reckless. And yet we're doing it.
Mhm.
I think we now have to look at the consequences of what we're doing and who we elected.
Yep.
There you
Agreed.
go.
So one more time, you have an article coming out in a few days. We'll post this on the same day so that everyone it all coincides. But again, for everyone out there, I'll post the links to the book that I've been reading. It's fantastic. And Zuber, any last comments?
No, I just want to thank Stephen for his time. I wish your daughter well in the cross-country journey, and I wish Yale much success and all the universities and getting students back in class. We need that. We need to take care of them. I couldn't imagine going to university and have to do it remote. That's got to be tough.
Pretty challenging, and yet education is our future, and we've got to figure out how to
Totally agree.
keep investing in that future and these young kids that are going to school. They have a huge challenge in trying to realize that dream, and we have a big challenge trying to teach them.
Yes, sir. Thank you for all you do.
Awesome. Thank you, Stephen.
Thank you, guys. Thanks a lot.
When I slow it down,